Hello, options traders, and a very big welcome to everybody new to the Options A to Z Facebook options group. And in this video, I want to cover a commonly asked question, and that is, what is it that makes an option an option? Understanding this answer is a key to successful options trading. To make the point, I posted a poll asking about some recent Home Depot quotes. And you can see the stock was trading for 150.52 right here. And my question was asking about the value of this 105 call with 7 days till expiration. And should you see the value of the option as this 45.60 total price right here? Or perhaps the 45.52 intrinsic value? Or the roughly 8 cents of extrinsic value? Which of these prices is really making this an option? Well, to succeed with options and strategies, you must be able to separate intrinsic value from the extrinsic value. And the extrinsic value is also called the time value. The intrinsic value is fairly easy to understand. If the option has an immediate benefit, it has intrinsic value. And the size of the benefit shows the exact intrinsic value. To understand what this means, I often make the comparison that call options are a lot like a pizza coupon. Think about it. If you have this coupon, you have the right, not the obligation, to pay this fixed $10 price right here, but you only have a certain amount of time. There's an expiration date. But let's say that you walk into the store and find that they're selling pizzas for $15. You have the right to pay $10. You have an immediate $5 benefit, and that is the intrinsic value. So this coupon has $5 of intrinsic value, and that's because you have the right to pay $10 for something worth $15. Call options work exactly the same way. If you have a $50 call and the stock is currently at $55, you have the right to pay $50 for stock worth $55. That's an immediate $5 benefit. So this $50 call would have $5 of intrinsic value. Call options will gain intrinsic value as long as that stock price continues to rise above that strike price. Put options work exactly the same way, just in the opposite direction. So if you had a $50 put instead, and the stock was trading at $45, you have the right to sell shares for that strike price of $50 when the stock is actually down at $45. So that's a $5 advantage to you, and this $50 put would have $5 of intrinsic value. Put options gain intrinsic value as the stock price falls below that strike price. If that's a little confusing, you can also think of intrinsic value as the cash value or the meltdown value. For example, let's say that gold is $1,000 per ounce, and you have a 1 ounce gold coin. Well, you know it has to be worth at least $1,000. That's the meltdown value. You could always melt down the coin and sell the gold for the market value of $1,000. That's the cash value or the intrinsic value of that coin. Options work in a similar way. All options must be worth at least their intrinsic value at all times. So let's go back to our Home Depot quotes here and take a look at the 105 call. If you have the Home Depot 105 call, when the stock is trading for 150.52, you could exercise that call and pay the 105 strike and immediately sell the stock for the current price of 150.52. That's the cash value. That would give you a guaranteed cash amount of $45.52. And therefore, this 105 call must trade for at least $45.52. That's the intrinsic value. Once you understand how to find the intrinsic value, the extrinsic value becomes very easy. It's what's left over after accounting for the intrinsic value. So we just saw that the 105 call must be worth at least $45.52. But we also saw in the quotes that it's trading for $45.60. That additional 8 cents is the extrinsic value. It's the price you pay for the right to walk away and not have to exercise your call option. The right to walk away with an option is a big benefit, and you have to pay for that benefit. So think of buying a call option like placing a bet at a horse race. You'd think that all bets must be placed prior to the race, right? That's what would make it fair. Well, what if you could wait for the horses to be halfway around the track before you placed your bet? It seems like it would be an unfair advantage. yet that's really what call options allow you to do. You get to lock in your purchase price today, but are not required to ever buy the shares. Instead, you can wait and see how that stock performs. You have the right to walk away from the deal if the stock's performance doesn't turn out as you expected. That is a big advantage, and that's why you pay in the form of an extrinsic value. Going back to the Home Depot quotes, the platform shows the stock is trading for 150.52, but the 105 call is trading for 45.60. It also shows the intrinsic value right here is $45.52, and the extrinsic value is this remaining roughly 8 cents. Notice that the intrinsic value plus the extrinsic value equals the option's total price. That will always be true. So to answer the poll question, it's this 8-cent value right here that makes this 105 call an option. So from a professional trading standpoint, even though the 105 call appears to have an expensive price tag at $45.60, it's really only an 8-cent option. So why is the option portion of that contract so cheap? Well, the 105 call gives you the right to pay 105 for stock currently worth 150.52. That's a big advantage. And you'll always have an advantage if the stock price remains anywhere above the 105 strike. However, because there's only 7 days till expiration, it's highly unlikely that Home Depot's stock price is going to fall below this 105 level. So traders aren't willing to pay a lot for the right to walk away and not exercise the call. Anybody in possession of this 105 call is reasonably certain that it will expire with intrinsic value and therefore aren't willing to pay a lot for the right to walk away. So what do we know about this option? Well, because this is an 8-cent option, it's behaving far more like shares of stock, not an option. And you can always check this by looking at the break-even point. Just take the 105 call plus the 45.60 total price and add those two together. And that gives you a total price of 150.60. In other words, by purchasing this 105 call, you're controlling shares for $150.60 instead of the 150.52 price in the market. You're paying just 8 cents above the current market price. But if you happen to see this 105 call as a very expensive option, you're missing out on the very benefits that options provide. This is a very cheap option. So if you've done well with your investments in the past or would like to begin, think how much better you'd be if you could control a $150 stock for less than 1/3 that price. And depending on the strikes that you choose, that's exactly what can be done. It all begins by understanding what makes an option an option. It is always the extrinsic value. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com. You can also contact me here through Instant Messenger on Facebook.